So in this video, I want to talk about a few ways to play Tesla earnings this week. So the first thing I would do is I would first find out the exact date of earnings. So I'd use several sources. So here on Questrade, it says earnings date January 27th, but it could be after hours or before market open. Usually Tesla is after hours, but then I would check different sites. I could check earningstats.com and just wait till it loads. It always starts with Apple. It has a calendar at the bottom here as well. I can click on earnings calendar, and Tesla here confirmed after market close Wednesday, January 27th. And maybe just add a third source, maybe Yahoo Finance, look up the stock. And obviously you could always check on Google, and you could always check Tesla's website. So if we check on Yahoo Finance, it shows earnings is January 27th, 2021. And even Yahoo Finance, they have a nice calendar here. If you just type earnings calendar in Google and just choose Yahoo Finance, they have a calendar that shows everything. So if I click on the calendar, so January 27th, and then it filters. Usually you could sort by before market open or after market open. So, okay, I guess I can't sort it, but it says here if it's after market close or before market open. And let's look for Tesla now. So we're assuming it's January 27th, or we know it's January 27th. We know it's January 27th, but we're just not sure if it's after market or before market. I know it's after hours, but I'm just showing you how you could find it. See, it's not there for some reason. Let me click on it again. January 27th, search for Tesla. It's on the next page. So let's look at the next page. Maybe we can find it without searching for it. Okay, I don't see it. Oh, there it is. Tesla after market close. All right, so I think it's enough. We've confirmed that Tesla has earnings at January 27th, which is Wednesday after hours. So typically you would want to make the trade on Wednesday before market close. And there are different strategies you can play on Tesla. So the first one I'll mention on Tesla, if you have the buying power for it, the best thing probably would be to do a wide strangle or even a naked put. So let's just look at our possibilities here. Let's look at a wide strangle. Let's start off with a wide strangle. First thing I like to see is what's the expected move. And to get the expected move, I'm going to look up the value of the straddle. So the straddle here is worth 880 at the money straddle. So if I go to 880, the straddle is worth $85. So that's the expected move. That's a lot. It actually went up. Last week when I was looking at it, it was I think on Friday it closed at around 70 points. So now the expected move is almost $86. So that's a lot. All right, so what we could do is we could do a strangle that is 86 points higher but also 86 points lower. So 880 plus 86 and 880 minus 86. So 880 plus 86, that's 966. And then 880 minus 86. So 880 minus 86. So 794 and 966 would be my strangle. We could start with that and then adjust afterwards to our comfort level. All right, so let's look up the strangle here. So I'm just going to click on strangle and just click anywhere. And then I'm going to adjust the strikes over here anyway. So click on sell because I want to sell the strangle, since with earnings, usually there's higher volatility, so the premiums are more expensive. So you want to sell expensive premiums. You don't want to buy them. All right, so if I sell them, I said on the call side, I would go to 966. So that's that expected move. So let's just say 970. And then on the put side, I said I would go to 794. So let's just say 790. And let's see how much I can collect from that. I can collect $23. So that's $2,300 from selling this strangle. Now, how do I win with this trade? The stock needs to stay between 790 and 970 after earnings or on January 29th. So usually what happens after earnings, even if it moves a little bit, but because there's going to be a volatility crush, there's no more uncertainty, the value of these premiums can drop hard. So you don't have to wait till expiry of January 29. You can usually close it right after earnings for a decent profit. That's assuming the stock doesn't move much. Now, of course, there's a risk that the stock drops below 790 or even goes above 970. So if that's a concern you have, we can widen our strangle. We can go, let's say we go to 1050. We can go to 1050 and we can go to 700, for example. Let's see what that gives us. So if I go to 700 on the put side and 1050 on the call side for January 29, so for this week, I could collect $800. That's still pretty good. I forgot to show you something. We said that on the call side, I would go to the 966. I just want to show you the capital required for this trade. So we said 970 and I think 790 on the put side. So that's the problem with this trade, is that it takes a lot of capital. So for this strangle, so the capital required for this trade is 26,000 US. So that comes out of your maintenance excess. So if I go to my account here, if you look at balances, it comes out of your total maintenance excess. So see, right now I have 47 combined US. So I would have enough to place this trade, but it does take half my ME, which is kind of risky. Now, let's say I'm worried about these strikes. I think that they could get breached. So let's say I want to play it safer and I want to go to 1100, even further away. And I want to go to, let's say, 700 on the put side for this week as well. So I'm much further now and I could still collect almost $600. See, the put side gives me 125 and the call side gives me 465. So you could obviously see that there's a slight call skew, that the calls are worth more than the puts at the same distance from the current market price. In fact, if we look up the option chain on Tesla, let's look at the 880. Where's 880? Well, it's actually trading almost the same thing. You can see that the at the money call is 43, the at the money put is 41. So it's not a big difference. All right. So now let's say we want to go to the call strike that gives us $1. Let's say we want to collect at least $1 from each side. And let's see how far we have to go for that. So we can go pretty far just to collect $3. So that basically means that there's definitely a call skew on Tesla. There's more risk to the upside because people are buying calls. More people are buying calls than they are buying puts. Because look how far I can go on the call side and still collect $1. I can go to 1380 probably, or 1400. Let's see, 1380 can collect $1.45. Let's see, 1400, $1.39. So let's say we pick the 1400 call and the 700 put. Tesla's at 880 right now. So the put is only 180 points away, but the call is more than 520 points away, and I'm collecting the same thing. If we look at the delta is almost zero, so it's pretty far, and I can collect $263. So that's pretty easy. I think this is the trade that I would do out of all the trades that I'm going to mention. I think I would pick this one because I would collect $200 and with a very good chance of winning because it's super safe. I mean, in terms of the stocks being very far. And let's see how much capital this trade requires now. So this trade will require 17,000. So remember, the other strangle required 26,000. This one requires 17,000 of maintenance excess. Once again, this comes out of this line here. It does not come out of my cash. It comes out of my maintenance excess line because I'm selling options. So I'm actually collecting a credit. So my cash goes up because I'm receiving credit, but my capital, my maintenance excess drops while I'm holding the trade. Once the trade is closed, then my maintenance excess will come back up. My cash remains the same unless I close it by paying for it. And if I pay more than what I collected, then my cash will drop compared to my cash balance before I open the trade. All right, so these are strangles. So either a very wide one or a strangle at expected move. Personally, I would probably take the very wide strangle. The other thing I could do is a naked put, just a simple put, just selling, for example. So selling, for example, I don't know, the 760 put and collect $400 or $300. Obviously, the closer we get to Wednesday might drop a bit, and the value of the premiums might drop a little bit. But I could sell the put without selling the call. So that would be a naked put. collect, let's say $350. $350. Now let's see, the capital required for this trade would be 23,000. So it's as much as the strangle, the initial strangle, and it's more than the very wide strangle. Now, I don't know where Tesla's going after earnings. I don't try to predict or anticipate where the stock will go after earnings. There is no way of finding out. I honestly find that the stock moves randomly. Sometimes there'll be good earnings, good guidance, and the stock drops, or bad earnings, bad guidance, and the stock goes up. It really doesn't make sense compared to the actual results. So I don't try to predict the reaction of the market. All I know is that I've always been selling. I used to sell iron condors on for earnings, or even iron butterflies, and I realized that I would always lose on the call side most of the time. So that's why I decided to just always go on the put side, always sell put spreads or sell puts for earnings, because they have a better chance of winning. But it doesn't mean that I know that the stock will go up. I just know that they have a better chance of winning. And obviously going out of the money, selling an out of the money put spread, it gives me room to be wrong a bit and still win on the trade. And if I ever sell the call side, it has to be very far. So if I consider selling a strangle on this Tesla earnings, it'll be because the call is super far away, and also because Tesla ran up a lot already. So it's due for a correction, but I'm still not trying to predict the direction. But there are more signs towards Tesla dropping, but it doesn't mean that it will drop for sure. Although the call skew suggests that the stock would go up. I mean, the calls are way more expensive than the puts in this case. So the other trade that I normally make is the put spread. That's, in my opinion, that's the safest. So a put spread at expected move, we said it was around 86. So it would put me at the 790 strike, and then I'd buy the 785. So that basically, I'm selling the 790 put, but I'm buying the 785 put, and it caps my loss. Basically, my loss is limited, is capped by the difference of the strikes minus the premium that I collected. So 790 minus 785 is $5. I collected, let's say, I would try to collect $1 at least. So I'd probably go to the 795 and then 790. See, in this case, I can probably collect $1, probably 90 cents. So let's say I collect $1, then the difference, then my max loss would be $4. So that's $400 if I do one contract. And the long put basically protects me. So see, if I did the naked put, I would collect $8. But because I'm buying the long put at 790 for $7, so the difference is $1 of credit. But I have that protection with that long put in case Tesla drops hard and goes to 750 or 700. Well, then my max loss is only $400. So that's a potential trade for earnings. And another way to play this is you can go to the further expiry. You can go to the monthly expiry, February 19 expiry. In that case, what I would do is, first of all, look at the expected move of Tesla for February 19. So look up the straddle, 880. So you see it's worth 150. So I'd go 880 minus 150. Let's see what that gives us. 880 minus 150. Feels like it'll be at 730. So then my strike will be 730. Then I'll do a put spread, but 730 strike instead. 730 and 725, 5-point wide. And you can see that gives me $1. But you see, if I did the naked put, I could collect $1,700. But by doing the put spread, I'm collecting $1. And this way, it gives me more time in case the stock drops and eventually recovers. Then if I have more time for the trade to win, my strike is slightly further. It's about 60 points away. And also, if the stock jumps up after earnings, I can still close this trade the next day. I don't have to wait till February 19th. So it gives me the opportunity to play. It gives me the opportunity to win in many different scenarios. If the stock goes up, if the stock stays put, I'll have to hold the trade. I won't be able to close it right away. And if the stock drops, well, I have time to wait for the stock to recover. All right, so I mentioned the strangle. I mentioned a wider strangle. I mentioned a naked put on its own. I mentioned a put spread, either same week expiry, which is usually my favorite, or a put spread the next monthly expiry if you just want to play it safe. I think that would be the safest. If you want the safest strategy, it would be a put spread to the monthly expiry. And then if you want the riskiest strategy, but the one that pays you the most, I'm always tempted to do this, but I'm always scared, but it would be selling the weekly straddle. So selling the same week expiry straddle, which we saw is worth $86 or $85. So you could sell the 880 straddle. So basically I'm selling the call and I'm selling the put at the money. What that does is I'm going to collect $8,600 in my account. It's going to come in. Doesn't mean that I keep it. Now my break even is basically what I calculated before. My break even is 880 plus 86, so 966, and 795 on the put side. So between 795 and 966, that's my profit zone. Anything outside that, I start losing money. But I have a point where I make max profit of $85 or $86 if Tesla closes at exactly 880 come January 29th. So that's unlikely. So I don't expect to make full profit of $86 or $85, but I could probably, if I sell this for 86, I could probably, if Tesla doesn't move much, I can probably close it the next day for $50 or $40. So then I would make an easy $4,000 with this trade in the case where Tesla doesn't move much after earnings. But if it does move outside each break even, but the risk, of course, with this trade is if Tesla does move hard in either direction and surpasses my break even point. But in general, usually it's not expected to, but it's still risky because it's a naked trade and it could go either way. So that's the problem with this trade. It's very tempting because you collect a lot up front and you can potentially close it for much less. I mean, the break even is the same as the first Strangle I showed you, except with the Strangle, your profit is the same regardless where the stock trades between the break even. But with the straddle, the profit is different. I'm going to log out here and I'm going to log into my IQ Edge just to show you the P&L chart. So it's easier to visualize on the P&L chart. All right, so P&L chart, I'm going to click on P&L calculator and make the screen bigger. Let's look up Tesla, choose it, select it, and we're going to add, let's add strategy, I guess. So let's start off with the vertical put, which is the safest. So what if we sold we said the 795 for this week and bought the 790. Where's the 790? So if I buy the 790, all right, so this is what it looks like. So the mid price is about 92 cents. So one contract is $92. So or $94 it says on this chart. So this is the P&L chart. So it shows me that my break even is right over here. My break even is at this point here, which is basically 795 minus the 93 or 94 cents that I would be collecting from this put spread, which is right over here. Here, let's see if I can zoom in on this. And my max loss is achieved if Tesla reaches 789 or 790, basically. My max loss is achieved when Tesla drops below 790, but anywhere above 795, I'm getting the same profit, which is $94. So that's what the P&L looks like for this put spread. If we choose the February 19 expiry, I would have, and I said I would choose the 730. So let's look up the 730 put and 725. So this is what it would look like. Let's zoom out a bit. There we go. So we receive about $131. That's what it's telling me right now. And the max loss is basically $369, which shows on this axis over here. So in green, it shows me max loss of $369. Gonna remove this line here. So anywhere above 730, same profit, and anywhere below 725, same loss. It's capped. Now let's say we try the let's look at the short straddle. It's gonna be interesting. So short straddle for this week. So same expiry, and at the money it'll be 880 right now. So the 880, look, this is what the chart looks like. So as you can see, the profit, my break even is 794 and about 968, but the profit isn't the same. It depends where it lands on January 29th. But my max profit is achieved at 880, of course, of $8,381. But let's say Tesla closes at 820 on January 29th, my profit is still $2,600. So that's what the short straddle looks like. I still have the same break even, but my profit is different. And obviously the loss is not capped if it surpasses my break even. Obviously there are ways to manage the trade if it gets surpassed, but I don't want to talk about this in this video because it's a completely different topic. Now finally, let's look at the Strangle. I'm going to remove these trades. I'm going to add strategy, add a Strangle. Okay, X over here. All right, so we're going to sell. We don't want to buy. We're going to sell the Strangle. And let's say we go to let's go to the wide Strangle. That's the one that I would potentially make. So 1400 call, and the put I think was 700. So on this one, I think this is the one where I can collect, yeah, $2. So I can collect $2.69, so $269. And look where my break-even zone, it's so much wider. It's all the way to 1400 on the call side and 700 on the put side for this week's expiry, for this Friday. And now the profit is smaller, $270. The risk is still bigger, but I don't think Tesla's going to surpass 1400 by this Friday. And on the put side, if the stock drops below 700, then I'm going to have to roll it as a naked put. It's going to take a lot of capital, but I mean, to me, that's the trade that makes the most sense. So that might be the trade I would do. So personally, I would probably do this one or just a regular put spread for this week. But in my opinion, the safest trade would be a put spread expiring February 19 on Tesla. All right, just wanted to share some trade ideas for earnings for Tesla. So if you have any questions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Also, check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.